Hey there, welcome to the channel. So today I want to talk about hedging my bets. Okay, now the first thing though is it's Sunday night, June 26th, and just a quick update like what things are coming, what economic data is coming this week. So look, on Monday we have durable orders and pending home sales. None of these, I don't know. It'd be interesting if pending durable orders go kind of negative. Those are larger ticket items, often involving financing, but they may last a while, but some of them don't as well. So it just depends on what it is. So that'll be kind of interesting to see how the consumer is doing with durable goods there. Then we have international trade, retail inventories. This is going to be interesting, right? Because the retail inventories, we're getting that sort of situation where maybe some of the retailers are having issues, the inventories are growing, and do they have the right inventory? Are the ports going to finally get unclogged? I mean, I don't know. China just, apparently they're unlocking. Or are they locking down again? Who knows? So that'll be kind of interesting. If anything pops up on that on Tuesday, I don't really know. Mortgage applications, blah. Interesting. The GDP third quarter estimate comes out on Wednesday. So we had the minus 1.4, then second was revised it to minus 1.5. And so we'll see. I guess they're expecting it to be the same. So we'll kind of see, but just note the deflator, right? So that is an inflation kind of measure. So you have the deflator in there. And then you also have on Thursday, then we get a bunch of things, claims aren't really haven't been in focus, but at some point you kind of start wondering if we're going to start getting spikes in those initial claims. If companies are laying off and more of that is happening than is widely known. So basically, the premise that I have is we are in recession or going into recession, but um, the market isn't fully aware of it yet at this point. So some of these things are non-issues right now. So for example, with PCE prices, inflation measure, personal income, personal spending, what's, you would suspect here is that, at some point, maybe, one of these other data series, like we've been focused on CPI very much and PPI, the inflation stuff. But at some point, one of these other indices, one of these economic indicators that they regularly report, which maybe people aren't focusing on very much, suddenly one of those might become very interesting. They suddenly might become interested in it as an indication of whether we're in a recession or not. PMI, that's another indicator there. So we'll see what happens with that. Now, okay, back to the next subject, trying to figure out what the heck to do. Done the videos on the water situation in the Southwest. Okay. And so one of the things I wanted to look at is I'm trying to figure out, what to do. And I'm trying to figure out how bad it could get. So one aspect I wanted to look at was home prices. So I do own a home. And then the question is, do I want to sell it? Like, what's going to happen here? In reality, this kind of analysis, I haven't even really factored into the fact that, okay, the water might actually run out. So for starters, we can go out there, we can get the median home price. So this is nationwide level. And we can see the big housing crisis back here, right? So home prices always going up. Back here in the 50s and 60s, before they took us off, they were going up at a moderate pace with inflation. But now we've had more advances. You see some places where it's slowed or didn't go up much, maybe a little decline back here in the early 90s, but really not much. And then here you see the big daddy here. This is the great financial crisis. And you see that home prices at the national level did decline a whole bunch. So now what I'm going to do is I'm going to look at that more closely in detail. So now I took the data, and this is government data. And so basically you can download the data and then plot it. So now I'm plotting from like 2005 here on the left to 2014. So I'm going right through the home price crash. And so we can see here a couple things. So the median home price at the national level over here, you see what's interesting, I didn't really know this, but this data was coming out, I think twice a month is what this data set is. And you can see that we had this kind of double peak here. So what I did is I took the worst point here, and then I put a point here after. You can see, it's a rapid decline, right? very steady, rapid decline once it breaks, but then it slows down and gets more blah, blah, blah before we put in essentially a double bottom. We get a low here and another low basically at the same price. But what's happening is this is taking like a lot more time. So this period here is a 1.5 to 2 year period of this initial decline. And then there's another couple of years before you finally get that absolute low in there. So what I wanted to do is I want to figure out like, hey, I'm in San Diego area. So I want to figure out like, hey, based on the house that I have, and I'll take what I did is I didn't use my actual house, but I used like a typical house for these areas. And I just rounded off all the numbers to get a typical kind of estimate. And what I want to do is assume that this is going to happen again. Now, that may not be the case, but given all the situations that we're dealing with, it's very likely that this is to happen again. So what I could do is I can pick like the high here, and then I'm going to pick this first low. And so what I'm going to do is I'm calling it, and I put the numbers over here in the dates. So we had a median home price of 217.9, and then it went down to 185, an initial drop of 14, call it 15%. And then an additional period of time over the next 3 to 4 years, it dropped an additional to overall 22%. Okay. So that's what you kind of see for the overall housing market. Now, because what I want to do is I want to get how much does it drop? Okay. And how fast does it drop? How much time do I have for decision making? And notice here that this thing is a very steady, just through the floor drop. And then you get some bottoming, right? But then it goes lower. That's fine, but it slows down. The pace of decline slowed down after that initial drop, which is 12 to 24 months. So I'm really interested in that initial drop because once you're on this thing, you're on it. So what I did is I found data for San Diego as well on St. Louis Fed. Now their data is based on it's got units basically of 100 in 1995, I think it was. So these are these units. So it's not 324,000, but this in the San Diego area, these are the declines that we saw. So in the first period of time, you saw about 30% and then followed 34% overall. So what I did is I'm trying to make kind of see how this plays out. Okay, so now I put them both together and you can see that there's continued declines after that. And geez, in the period of time is like 72 months altogether to get to that final low. So it took really a long time to get to the low. There's this initial rapid decline and then there's more decline. So what I want to do is I want to focus on just the first 2 years and I'm going to be pessimistic because that's what I'm going to do, right? If I'm doing a spreadsheet, I mean, I can try to be optimistic, but I want to be, just tell me what it is. And so what I'm making an assumption, because in reality, I've seen other charts of the housing and it's more like the declines were 50%. Some neighborhoods had lots of foreclosures and lots of builders, and the declines were much more than this, more in the 50% range. So I'm going to say pessimistic is 50% in 2 years. So it's going to drop 50% in 2 years. That's 2.1% per month drop. Okay. Now that's not how it works in reality. It's not going to be a smooth line. It's going to be bumpy, but just kind of get an idea of what's going on. And then I'm going to have the optimistic case, which is minus 30% in 2 years. Okay. So then I go over here and I say, so this is for a hypothetical house situation here. Okay. So what I did is I said, hey, we have a hypothetical house that's worth $1 million and the neighborhood I live in, there's so much $1 million crap around here. It's just stupid crazy. All I can tell you, I'm not rich in any way, I assure you, but it's amazing around here. Just homes are worth all kinds of crazy freaking money. And they've gone up crazy value. So it's just rather amazing, but we just picked the starting point and call this starting point now. So I just picked a house that's valued at $1 million. And, trust me, that's, that's there's a lot more on a much higher end. So that's on the lower end of things. And then, with a mortgage of 500,000. So, basically I have minus 2.1% if we're 50% loss or 30% loss. And then, so right now, note that the LTE, loan to equity at this point is 50%. So this person has paid off the mortgage. So they maybe have been sitting in the home for 10 years or something and bought it for a more reasonable price. And they've been paying it off at the same time that they've gotten massive appreciation in the housing market. So what you can see as this goes on, you can do the equation here. So 1 plus your appreciation, which is negative in this case, times the value, will basically, for that first year, that's a minus 2.1% of the previous value. Well, then it goes down the next month, another minus 2 points. So you see how it's dropping down. So we have for the house price for the 50% case, house price for the 30% case in 2 years. And then we have the equity. In the equity, we just take that the current value of the house price, and subtract the mortgage that is in there. Okay. And that will give you the equity that you have. And you can see if you plot these out in 2 years, and you really, if you just look at the chart, you don't even need the graph, at the minus 50%, your equity drops to 103,000. So here you have a person that's theoretically sitting on 500K of tax-free, assuming they're living in it, 500,000 of tax-free money. And in 2 years, that's going to go down to 100,000. So they're going to lose almost all that money. And then over here, another case, well, if it doesn't go down as much, then they're a little better off, but they still lose half their money. And you can kind of see it on the chart here. So this is the kind of thing that I'm trying to deal with, because I'm trying to understand. My gut is telling me that I need to move now. And because I know we're going into recession, is it a depression? How the hell do I know? But it's like, it's coming. If this is the decision making, is this the decision making is like, okay, look, if I stay here, I have to ride this out. And what that means is, like, if what I really hope is, I hope I'm over here at the green square, meaning that there's going to be a little bit, like, maybe there's going to be a decline that we have, which is very little at this point. And there may be a bump coming later, because maybe the way the interaction with the Fed is, maybe at some point rates are going to stabilize for a little while, and before the Fed really hammers us. I have no idea. I have no idea, but that it maybe get lucky with that, but hopefully not. But my point is that if people that are in this position, if they're going to hold on, they have to make the choice now. And the thing is, if you're going to hang on, then here you are, you're in 07, you're not going to get back to there, right? You're not going to get back to there. This is 2014. So you're talking 7 years, 10 years for you to get back to where you were. You're never going to get back there. I mean, you will, but you're going to have to wait 10 to 12 to 15 years, 10 to 20 years to get back to where you were, assuming they have a similar cycle like this. So that's the problem that you have. Now, in 10 to 20 years, when Lake Mead goes dry in 3 years, that's what the issue is. That's the thing that I'm struggling with. So it's quite a freaking mess. It's quite a freaking mess. So yeah, this really does suck. The big donkey. My gosh, just what a mess. And I think this is fairly typical for many Americans. Look, because we've had this house price appreciation in many areas. So I'll just take California. Like, for many people in California, this place is just crazy, man. It's just crazy. Like, the housing prices, like, go up massively. It's just crazy how they move. And the point is that there's people sitting on big chunks of equity like this, and it's people sitting around with a lot more than that. And the problem is that, it's just going to dry up. And you can imagine that this is monthly. So this is like, and this is monthly based on, national home price decline. Once you realize, once it cracked, it fell through a floor. Now, so the point is, and then it didn't come back for 7 to 10 years. So this is sort of the issue that I think everyone has to kind of figure out, like, what do they want to do? And this is not financial advice. Now, from my perspective, conceptually, I wouldn't care. I mean, I wouldn't care. I'd be like, I could just live here or whatever. California has its issues, but fine. It's no big deal. But the problem is, if the water runs out, then this thing, you think this is a steep line over here. I mean, the water runs out. It's going to be like this, and it's going to go boop. It's going to be like it's going to be like Bitcoin or some of those other stable coins that have just gone to zero. This is going to go boop right off a cliff and go. So I don't want to be around for that. So that kind of really stinks. So looking at the San Diego area, you can go to the St. Louis Fed. Now, this is the one where I grabbed the data to try to estimate the decline that we had. So as I said, this is in units. So this is not in dollars. It's in 1995 equals 100, not seasonally adjusted in quarterly. So this is how the data is going to vary compared to the other data set I was showing you. But you can see, so you can go to your neighborhood or your community, try to go to Fred and figure out what happened in your part of the country. So if you're I mean, my guess would be like in this housing thing, this is California. California is a high beta real estate. So it moves up and down a lot, very volatile. I would think a lot of Florida, the Big Short. Florida was the epicenter for a lot of this as well. So Florida probably had a big drop like this as well. So you can kind of go to your area to kind of figure out what you think might happen. And then the problem that you have is what you have to hedge your bets, right? You have to kind of play the game of, well, what's going to happen here? Is this going to happen again? Or is this not going to happen? So let's compare what was going on in the great financial crisis. We had a lot of really, really risky loans that were written, right? You had basically a confluence of things where the financial markets, and it was coming from two different sides, very powerful constituencies. One was Wall Street. Hey, Wall Street was like, we want mortgages. We want mortgages, mortgages, and mortgages, because we're going to take those mortgages and we are going to make so much money on them. How are they going to do that? Well, we're going to mix these things up into different securities. So they have mortgages put into mortgage-backed securities, and then they go split those up into tranches, CDOs, different tranches, CDOs, CDO squared, whatever. And then, okay, we literally don't, and this is the part in that movie, The Big Short, that I don't think they make quite clear, but when they say synthetic CDO, well, what does that mean? It's the opposite bet that Mark Baum was making. So Mark Baum had a swap. He was betting against a mortgage, right? And he was betting against a CDO, which is a collection of mortgages, right? So he's betting against that bundle of mortgages. But what if you don't have enough mortgages? I mean, that's literally what happened. You literally, hey, we don't have enough mortgages. Well, you don't even have enough houses to create enough mortgages to stuff into mortgage-backed securities, into your CDOs. You don't have enough. So how do you do it? What do you do? Well, I want to keep money. Well, you create a synthetic CDO. So what is a synthetic CDO? Well, it's just synthetically you created a device that's going to act in some way like a mortgage, like a group of mortgages. It's synthetically created. So that's kind of what they did. So you have the Wall Street side, greedy as heck, and just loaning. They just need the mortgages. They don't care if they ever got paid off. They don't care about it. They're just like, we just want the money now, because they're all just selling the mortgages off and selling the securities off. So they're not sitting on it. So you had ninja loans, all these loans that were really bad, and that just led to the thing imploding. Okay, so that was that side. And then you have the other side, the government trying to help people by trying to force the companies to lend to people that are less financially able to buy that house, make it easier, make it for, very little down, VHA loans, blah, blah, all these different loan types where, you don't have to put much down. Okay, that's fine. In a way, it's noble, although misguided. But that on the other hand, you have a bunch of people that literally can't afford the house, and you're selling them houses that they can't afford. So they're getting double screwed, because they're getting screwed in both ways. They're getting the worst end of it, because eventually they're going to lose the house, and eventually they did. Many stayed in houses for a year, 2 year, whatever, were able to milk it, but eventually they lost the house, and they lost whatever money they did have and put into it. So very sad, and it didn't help them out. And secondly, Wall Street ended up making whatever money was there. So you have those two things. So now the mortgages are a lot better right now, right? The mortgages are a lot better. But the counter is that we didn't have a lot of inflation then. So the counter is right now is that we have a lot of inflation. So we had the Fed cranking up rates. The Fed, there's all this talk now of the Fed pivoting. Well, the Fed could pivot, yes, but the question is when. And the problem is they really have to take a ding out of that inflation. So this is where it's a little bit different when you look at what happened in the Fed in 2020. So you can look over here, see this recession, 2020, what was happening in here? Well, this is the cerveza sickness. When this thing fired off, the Fed just dropped rates down to zero. They just dropped rates down to zero. The government sent out stimmy checks, and the Fed just was easy as could be. So they just poured money in. And because there's no inflation, you can get away with it. But now we have the inflation. So now there's no easy way to do that. You pour more money in to plug the hole in housing or whatever, you're going to have a problem, right? You're just going to cause more inflation, which is bad. So this is could be somewhat different, but I think it's reasonable from my perspective to kind of take, what happened there and compare and assume that that's happening now. And the reason is because people are still in a situation where they're buying these homes that they really can't afford. They can afford them as long as they have their jobs, but the problem is that they still have the high inflation, and the high inflation is making it harder for them to afford that home. And so, just like before, you're going to have all these people that are just going to be struggling to make these payments because everything's like the car payments going up, this is going up, that's going up, and we're going to have massive job losses that are coming. And it's part of it is because the companies are going to have to cut back. They're going to have to cut back to deal with the inflation problem. The fact is they haven't been able to pass all the pricing on, and so therefore their margins are being compressed. And I come from the engineering, and so what happens in the engineering world? Well, what happens in the engineering world is they cut back on development and they say, okay, look, well, we're only going to do a couple chips next year instead of the 10 we wanted to do or whatever it was, right? So they're going to cut back and they're going to cut the people. That's just how they do it. That's what they have to do to cut down their costs. So all that's going to start happening. And when all that starts happening, people will lose their jobs. They're going to lose the homes. There's going to be like a lack of jobs out there for a period of time until everything just, has to crunch. The economy has to crunch. Everything has to crunch down, go to a much lower level, then it can recover. And so, when you're sitting here and you're at here and you see it flattening right now, right? You're seeing the Redfin data where the price reductions are coming now. So which means the prices are still going up, right? They're just reducing what they're asking right now. But, at some point it's going to turn, and it's going to turn pretty fast. And then from there, we'll see where we go. All right. So I think I've rambled. Oh my gosh. I think I've rambled on too much. All right. Talk to you guys later. Bye.